It's important to look at expected emission reduction of investments. So yes, it's hugely valuable to invest in green companies today, and that's great. But the value of going where the emissions are and bringing down emissions substantially, it can be enormous. Obviously, it's enormous from a climate perspective, but also from a value creation perspective, because if you have high emissions and no plan to get them down, or a plan without capital to get them down, then you tend to trade at a low valuation. And so there's true value creation that's there. And certainly we're seeing that in a number of cases.
Welcome to the Future in Sound podcast. I'm your host, Jen Wilson. This is a podcast where we discuss people, planet, and profit. In each episode, we'll learn from world-leading experts who can help us see the future we want and our role in it. This is episode 35, Brown to Green. Mark Carney is the UN Special Envoy for Climate Action, Chair of Brookfield Asset Management, and Head of Transition Investing at Brookfield Corporation. Across these roles, he's focused on developing tools, guidance, and products for investors that will combine positive social and environmental outcomes with strong risk-adjusted returns. Mr. Carney was previously Governor of the Bank of England from 2013 to 2020 and Governor of the Bank of Canada from 2008 to 2013. Internationally, Mr. Carney was Chair of the Financial Stability Board from 2011 to 2018, chaired the Global Economy Meeting and Economic Consultative Committee of the Bank for International Settlements from 2018 to 2020. Finally, he served as first Vice Chair of the European Systemic Risk Board from 2013 to 2020. Prior to his governorships, Mr. Carney worked at Goldman Sachs as well as the Canadian Department of Finance. He's a long-time and well-known advocate for sustainability, specifically with regard to the management and reduction of climate risks. Mark Carney, welcome to the Future in Sound podcast.
Thanks for having me, Jennifer.
So I wanted to start with where we are in terms of climate change. So it's virtually certain that in 2024, it will be the first year in recent times where we're more than 1.5 degrees Celsius hotter than pre-industrial era levels. Now, obviously, listeners to this podcast know that there's a difference between climate and weather. And at the same time, I think this is significant. I'm wondering, what do you think this means for investors?
Well, I think it is significant, and it's partly, determined by some cyclical atmospherics, but underlying is the continued depletion of the carbon budget and the relationship between that and the climate. And I think from an investment perspective, a few things are underscored by this. First, we've seen the ramp up in extreme weather events, not surprisingly. And so it's a reminder of the scale and the importance of physical climate risk. And, just to put some numbers around it, and some investors are in the reinsurance and property and casualty insurance sector, the liability side of their balance sheet's much tougher. And we've seen, for example, reinsurance rates, property and casualty reinsurance rates are up about 50% over the course of the last 3 years now. Coverage is adjusting. I mean, I'll just say as an aside, one of the things that always struck me when I was at the Bank of England and we oversaw that industry was just how good they were at managing those risks. But what it meant was that tail risks were becoming central scenarios, and they had to manage it. So it's demonstrating the physical aspects of those risks. Also, unfortunately, but predictably, the more extreme weather has reinforced some of the channels that aren't modeled when people think about the ultimate economic impacts of higher temperatures, such as greater migration, internal conflicts, and those elements, is just apart from the impacts on actual work. I guess the other thing is, from an investment perspective, it does underscore the challenges in meeting that carbon budget, the one consistent with 1.5 degrees, in the implied tightening of policy that would be necessary, and making judgments about what actually is going to happen going forward, and how that which companies and sectors are better prepared, and which are exposed.
And while these clear financial impacts and I guess relationships between financial impacts and, as you were saying, migration and issues that are much broader are being brought to bear on societies globally, we're also navigating the politicization of net zero. And so in the past couple of years, we've seen a backlash against ESG and net zero. It's been intensifying, particularly in the United States. In Republican states like Louisiana, that's pulled out from investors who have net zero goals. I mean, despite great work by GFANZ, we have seen some financial institutions drop out of important alliances for fear of material legal risks associated with coordinated emissions reductions. And now we have Trump, who's been elected, and behind closed doors, there are some who are saying or questioning, is ESG or net zero dead? And I'm just wondering, how can investors best navigate this politicization of ESG and net zero?
Yeah, well, it's certainly a topical question for all the points you make, and I'll provide a bit of context. So, as you know, I focus on the E of the ESG, and within the E, the net zero subset of the E. So, within the subset of the environment, and not to downplay all the other elements, but this is the area that is measurable. It has in my judgment, the largest impact. It's the most mainstream, and there's the most mainstream mapping from the actual physical effects. We just talked about some of those, and the actual policies, the mapping of the policies to try to address mitigation, the mapping of that to value in the market, both from a risk management perspective, but also from a value creation perspective, driving opportunities. So within that context, it's one of the reasons why, for example, you referenced GFANZ, which I co-chair with Mike Bloomberg. We're north of 700 institutions now, north of 160 trillion of combined balance sheets. So if we rolled this back 3-4 years ago when it was launched, or 3 years ago maybe, to COP26 in Glasgow, those numbers would have been in the low 400s and about 120 trillion at the time. So despite headlines, the net scale of it has continued to grow, and part of the reason why it's continued to grow, and I'm saying this about GFANZ to make a broader point, is because of the mainstreaming of decarbonisation investment globally, and not all of this is available, obviously, in the public markets, but globally, the size of investment in clean energy, all aspects of clean energy, has quadrupled over the course of the last 8 years to it'll be 2 trillion, it'll be north of $2 trillion this year. And that's more than twice the scale of investment in conventional oil and gas infrastructure. So, if you're going where the emissions are, so to speak, to solve those, but it's also where the money is. And I think that those dynamics, which are driven, yes, originally by climate solutions, but now driven by relative economics, superior economics, and better energy security as well. Those are going to remain, and there's plenty of opportunity that's going to be there. Now, there will be, there's changes of government, changes of priorities. We will see some of that in the United States, but I feel, at least in this area, given proven value creation and necessary risk management, that it's still very, very robust.
We've certainly seen at Rico, working with clients on decarbonization, that there's also, an positive EBIT impact, not just in cost reductions as energy efficiency is improved, but also new product opportunities.
Just picking up on what you just said, the way I've always thought about broader ESG, so, literally thousands of potential metrics for a broader ESG. What's relevant is how a company manages. Where do you prioritize as a company? Where do you see it being most important for your clients, your customers, your stakeholders, and how you manage that? It's never the case that it's all thousand of them, nor is it, as I just might have implied, nor is as simple as only managing carbon.
I think that's a great point, really focusing on what's material and
Yeah.
financially material. And when I look at some of the backlash that we've obviously been following closely, a lot of it seems to pertain to differing views on investments in new oil and gas projects. So, with oil and gas prices that went up significantly after 2020, there were opportunities seen by investors in the short term. But at the same time, obviously, with a 1.5 to 2 degree, warming level, there's no room in carbon budgets for new fossil fuel projects. And this is sort of at the crux of it, Mark, I think, when fossil fuel investments are profitable and creating well-paid jobs for working class people in the short term, like how can investors pursue net zero while also honoring their fiduciary duty and valuing solidarity? Now, you've spoken to some of the macro trends that show that there's a ton
Yeah.
of opportunity, but just there are some tough trade-offs. And how do you think about that, Mark, in the short term?
This is a complex issue, and it's a fundamental issue of fairness, solidarity, as well as sustainability. I think the first thing to recognize is that, and we did a lot of work with the IEA, the International Energy Agency, who's I think probably has the best view on global energy trends. And part of that work was motivated by being clearer about what's required in conventional energy as we go through this transition. And one of the outcomes of that was, and this is oversimplifies it, but one of the outcomes of that was to look at what is the ratio of investment in clean energy to conventional meaning oil and gas today and going forward that would be consistent with that transition. And the answer is it should be about 2 to 1 right now. Actually, it turns out it is 2 to 1, clean to conventional, and it should scope up and to about 4 to 1 just in terms of the core energy. Higher if you include all the energy infrastructure, gets to 8 or 9 to 1 by the end of this decade. I think the important point though is it's for, I'm going to use the smaller one because it's a more apples to apples comparison. It's 4 to 1, not 4 to 0. So it's not nothing invested in oil and gas because of decline rates and that aspect. On top of that, for reasons of solidarity and energy security, there is going to be, in my judgment, more investment in conventional energy. We want to have gas resources available for many reasons, including displacing Russia in their illegal invasion. I mean, that's solidarity with Ukraine. It's right for a rules-based system for all these reasons. So it's nice that Russia has all these gas reserves, but we don't want them, and we want to build that up. So I think it gets to a point in terms of there is some oil and gas reserve development material, I would say. Secondly, thinking about it from a perspective of where is it going to be lowest risk, highest value, and then you get into low cost. And last point, if I may, again, from an investment perspective, and I think this was a important outcome from the Dubai COP, was having just under 50% by production volume of global oil and gas committing to near zero methane by 2030. So that's everyone from Exxon to Saudi Aramco making those commitments. That's material, and that's important, conventional production, but minimizing the carbon footprint of that process.
And of course, for listeners, we hear a lot about CO2, but methane is much more potent in
Yeah.
global warming potential, even if it doesn't last in the atmosphere for quite as long. So a really important.
But it certainly lasts for, I mean, if we're looking at our own lifetimes, it will be,
Yes,
unfortunately, it's quite significant. Yes. Yeah.
absolutely. Hey, it's Jen. I just wanted to take a quick moment to let you know a bit about Rico and what we do. We're a tech-enabled advisory firm that helps private market investors and companies measure sustainability metrics using our software platform. We also help you to set targets and focus your efforts on sustainability areas that really matter for your business. And finally, we help clients to translate all of this work into your core value creation strategy or your business model. Check us out at re.co.com to get in touch. All right, now back to our conversation. So we work a lot with private equity investors who tend to have a longer term time horizon. How do some of these trade-offs or, thinking, how would this shift a bit in private equity versus public markets where there's a bit more time to play with to get to a return?
That's right. You know this well, and I'm sure your listeners, many of them do. But the market is made up of a variety of types of investors. They have different perspectives, and some of them are very focused on yield as well as modest growth. And some sectors, notably in commodities, including oil and gas, there is an expectation that a substantial proportion of their cash flow is returned to shareholders. And the consequence of that is obviously, there's a range around the figure I'm about to give you, but on average, for oil and gas companies around the world, they're spending low single digits of their overall cash flow on investing in renewable energy. So they largely invest in conventional energy. That's what they know. And then a substantial portion of the cash flow they get from that, they return to shareholders through dividends and share buybacks. So they're less investing in the future, if I can put it that way, recognizing their expertise. I'm not saying they're doing nothing, but there's less of it in relative terms. Now, that money that goes back to shareholders ultimately can find its way, including to private equity, which is the core of your point. And private equity is one of the areas where you don't need to return the capital immediately. In fact, you have a horizon of 10 to, let's say on average a decade. And so there can be substantial investment up front in order to get the returns down the road. And that is one of the reasons why people like, and I chair Brookfield, as you know, people like Brookfield are very substantial investors in clean energy. We have over 100 billion US of dollars of renewable power assets. We're building out 7 gigawatts a year now of clean power. And last point, and this is a crucial point, which kind of brings where we started on ESG in Paris and 1.5 degrees and equity investing is we can also go and buy higher emitting companies and assets with a view to making large investments to get those emissions down to being consistent with a 1.5 degree world over the course of that horizon, that 8 to 10 year type horizon. And it's tough for let's say some European asset owners or investors to own those assets because they have a shorter horizon and they need to be, and I'm going to simplify it, to be green, sort of out of the gate in their investments.
One of the ideas that you've shared that I absolutely stole, Mark, and that I love is
Good.
the brown to olive and olive to green. It works really well as a communication device. I guess my question for you is, in assessing over a longer time horizon, say 5 to 10 years, what are some of the rules of thumb or mental models that you would use to ensure we're differentiating between a brown to brown investment and a brown to olive investment? What do you need to believe to sort of say, okay, we're making a difference in the green transition, even if we're investing in a brown asset?
Well, you need a plan. I mean, I've learned over the thing, you need a transition plan out of the gate and a sense of the horizon over which you're going to wind down the higher emitting assets and build up the greener ones so that you made that transition. And so, for example, there are in a variety of jurisdictions, particularly in the OECD, where you have utility companies that have a mixture of generation sources, including in some cases coal. Those companies tend to trade at quite low multiples relative to their cleaner peers, if I can put it that way. And so there's an opportunity to go in with those companies, invest in them, maybe take them private, and then do both legs of the transition. You obviously don't shut down the coal until you've built up the green, but you're doing both. And again, on that horizon so that it's consistent with the 8 to 10 year horizon of the underlying fund. I think that one of the things, if I may, which increasingly appreciate and want to, and I'm using your podcast to broadcast, is it's important to look at expected emission reduction of investments. So yes, it's hugely valuable to invest in green companies today, and that's great. But the value of going where the emissions are and bringing down emissions substantially, it can be enormous. Obviously, it's enormous from a climate perspective, but also from a value creation perspective, because if you have high emissions and no plan to get them down, or a plan without capital to get them down, then you tend to trade, as I say, at a low valuation. And so there's true value creation that's there. And certainly we're seeing that in a number of cases.
We've certainly seen that as well, Mark, where it's, like entering a new market, and the multiples are completely different. And so it's a really great point. I'm wondering just briefly, where are opportunities being missed in the sort of brown to olive or brown to green?
I think where we collectively are missing, and I'm not going to blame it on the mark. There's this $20 bill line on the pavement, is in the heavier emitting sectors. So I think heavy duty transport, aviation, steel, aluminum, cement, those areas, which you roll them all up, and it's just under 30% of global emissions when you take them as a whole. And one of the things that we're learning is that in order to get the scale of investments to deploy the technology in those areas, you need greater certainty of demand. So it's either through standards that are coming into place. For example, you're talking to me from London, and in the UK and Europe, there is a minimum sustainable aviation fuel blend that will be required, for example, for all planes that fly in and out of Heathrow as of the end of this decade. The consequence of that is that creates upstream a huge opportunity in sustainable aviation fuel. So a company like Infinium becomes quite profitable, came out of Breakthrough Energy. It's a Brookfield investment, and that moves that way. So where we're missing, and let me make one point to make this clear. So as one of the co-op initiatives, I'm involved in something called the Industrial Transition Accelerator. There are 700 different investments that would make up, if all done, about 80% of the emissions reductions that need to happen over the next 10 years in these heavy emitting industries. About 120 of them are now greenlit, they're proceeding. For the balance, it's a question of demand. So it's a question of standards, it's a question of green procurement, it's a question of, in some cases, moratoria or quotas of certain demand. And those are choices for countries to make, but I think shining a light on that will create big investment opportunities and big decarbonization.
So, Mark, in advance of this interview, I reread your book,
Oh my God.
Values, and I really love the core philosophy to your book. So, when reading, to quote, our moral sentiments live on as memes that multiply through values in the service of others, this idea that we can have an impact through those that we influence over time. I just wondered, what's one thing that every investor could do to adopt this longer term perspective in their work?
Oh, can I do two? Can I
You
do
can
two
do
things?
two.
Yeah, I can do
You can
two.
do two.
I think one thing that I've adopted over the years, and I think has served me well, is we can all anticipate some bad things that could happen, right? And quite often, and I do this as well, I then convince myself why it's not going to happen. Instead, it's much quicker and easier to say, okay, let's assume the bad thing happens. We have the prospect of a trade war, I think, as we record this. Assume it happens, and assume these tariffs are in place. What would I want to do today in order to prepare myself for that? And then is it worth taking out that insurance today? Just understanding, managing the downside, and having that perspective. And then secondly, having a perspective of what needs to happen for the bigger issues and positioning yourself to be part of that solution. If something has to happen, it will happen eventually. We will get to net zero around the world. It's not clear when we will and on what trajectory and how much methane and carbon we will emit over the process there. But how can I help catalyze that solution and create value alongside it? So there's both the downside and the upside of having that longer perspective.
I'm just conscious of time. I'll ask you one final question, Mark, before we close off for the day. Is there a book that's most shaped your thinking on approaching net zero? And if so, which one?
I'm going to give you an odd one. It's not an investment handbook, which is, I would say, Adam Smith's Moral Sentiments, Theory of Moral Sentiments. And the reason, and if you just reread my book, you remember this, but his core philosophy is about exchange. Life is about exchange. So we exchange value in markets and trading of goods. We exchange meaning and language, and we exchange esteem in our interactions, in our moral sentiments, and what do we value in others? What do we rate, if to use a modern term, in others? What behaviors are those? And that last aspect means that what we can create value by modeling value and value in certain aspects, like sustainability or valuing diversity in the workplace. And by doing that, that creates value in the market. If you help provide the solutions for those, then you've created value. And that's the way we bring the two together. And I think that I would credit him with as the master of markets, and also those moral sentiments as being the originator, at least for me, of those ideas that people like Michael Sandel and others have developed over time.
Mark Carney, thank you so much for joining us on the Future in Sound podcast.
Thank you very much, Jennifer, for having me.
The Future in Sound podcast is written and hosted by Jen Wilson and produced by Chris Attaway. This podcast is brought to you by Rico, a tech-powered advisory company helping private market investors pursue sustainability objectives and value creation in tandem. If you enjoyed this podcast, don't forget to tell a friend about it. And if you have a moment to rate us in your podcast app, we'd really appreciate it. Until next time, thanks for listening.